Hello and welcome. I'm continuing my series of modeling how-to videos based on the problems from ModelOff, the old World Financial Modeling Championships, now defunct. And this week we're looking at round 2 from 2013. So I did a pivot table data analysis question on Monday. I've got a LBO modeling question to come on Friday, but today is about cash flow forecasting. So just take a quick look at the introduction. There's not a whole lot there. So you're a manufacturer of action figures, blah, 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 blah. Forecast cash flow for the next 3 years, particularly the next 12 months. 3-year monthly cash flow forecast starting from October 2013 and use it to answer the questions. And then there's all these assumptions. I don't know why they even put them in the PDF file, but they're all in the Excel file as well. And then just questions, which is all we'll need from that. So I'm just going to squidge that over to the side, and then we'll come back to it when we're ready for it. Okay, so here we've got seasonality of sales. So sales are heavily toward the end of the year, 30% in Q3, 35% in Q4. Equal sales for each month within the quarter, irrespective of the number of days in the month. Then we've got, this is the number of units sold in the full year of 2013, and then the percentage growth for each year after that. And one thing just to mention here, if you look in the formula bar, you'll see this, CY Q1, calendar year Q1, is actually just a 1 up here with some formatting playing around. So that'll actually help us later. It'll be a little easier to, if we need to do a lookup or something like that. These are just, they look fancy, but they're just numbers. So we have a sales price per unit, a contribution margin. We have indirect costs, again, by year with a percentage growth, fixed and occur monthly, irrespective of sales. We have an amortization schedule for our debt. Then we have cash receipts timing. So for our opening receivables, 30% of it will get paid in October, 60% in November, 10% in December. And then after that, for any sales, nothing gets paid in the month of sale. 60% gets paid the month after, 25% the month after that, and 15% the month after that. And a similar thing for purchases. We have to, so you can see how this company is having cash flow issues. You have to pay for everything, 85% in the first month, then 10%, 5%. So your bills are getting paid faster than your income is coming in. So selected assets and liabilities. We've got a bit of cash, lots of accounts receivable and PP&E, and we've got accounts payable and a debt facility. And that's basically everything. And then we have a slot here to make the forecast. And I will say, don't do this. Don't lay out your assumptions and then build a forecast underneath it, because you're going to want, once this model gets big, you're going to want to freeze panes so you can see these dates at the top. And then once you do that, you won't be able to see your assumptions anymore. So I'm just going to rename that to assumptions, and this can be model. And then on the assumptions tab, I'm going to delete the forecast piece. Oh, and sorry, it just mentions here no taxes. Lots of historic tax losses. Which is a classic way of saying, let's make things as simple as they can be. All right, so we'll have our forecast on a separate page, and let's start with the basics. First thing, before we go into that, it will be helpful to fill this out. So I'm just going to put in here this times 1 plus that, put that across to all three, and format it as a number, and do the same thing for the indirect costs. And the second thing is, for these, for the cash receipts on sales and cash payment on purchases, it's actually going to be more helpful to have them the other way around, because if you think about it, if I'm in a particular month, then the sales from the current month are here, the sales from 1 month before that are here, the sales from 2 months before that are here, and the sales from 3 months before that are here. So if this was laid out the other way around, then I could kind of do a sum product or whatever. It would be a lot more straightforward. So you could, do some funky stuff to kind of index and manipulate and whatever, but sometimes it's easier to just lay your assumptions out in a way that is helpful. And just watch out, because this is 1 minus the sum of those, and that got confused when I moved the range. So we just have to fix that formula. And that'll make that a little easier to use. And then we'll do the same thing for the purchases. And again, it'll get confused for a second, but don't worry about that. I'll just fix the formula here. And then move it back over here. Okay, so let's start from the top. So we've got assumptions that are by quarter, we've got assumptions that are by year. So let's, in addition to our other things, let's put in a year and let's put in a quarter. So the year, we can just use year of that. I'm not putting it in for this one because we're just building the model starting from October. I'm going to hide everything after there. It makes it just easier to copy things over to the right. I'm also going to, I'm going to get rid of some of this fluff that we don't need so I can have it a little closer to the top of the screen, and then I'm going to freeze panes so that all this stuff is visible. And then the quarter, so we can extract the month number from here, and then if we divide that by 3 and round up to a whole number, that gives you 4 for the fourth quarter, 1 for the first quarter, 2 for the second quarter, 3 for the third quarter, and so on across. Okay, so having done all of that, 6 minutes in, I feel like I'm going a little slow, but trust me, I'm pretty sure I'll get there. All right, so in 2013, we sell 175,000 units. In the fourth quarter, we sell 35% of those, and in each month, we sell 1/3 of that. So unit sales is going to be, I'm going to XLOOKUP my year in here. Oops, sorry. Pressed escape twice. Only meant to press it once. Try that again. XLOOKUP my year in here, returning from here. Then I'm going to multiply that by my quarter. I don't need to do a lookup on the quarter because these are numbered 1, 2, 3, 4. So just a straight index will do fine. So we'll index on that by the quarter number, which is $10. I should really have put dollar on that 9 as well. And then divide by 3. And then we'll format that as a number and copy across. And one quick sense check, you can't do it for 13 because you only have one quarter, but let's look for 2014. If I sum up the whole year up to December, that gives us 182,000, and that matches the annual number there. And I guess we could do another quick sense check, which would be sum of these 3 divided by that 182,000 should be 35% for Q4, and it is. So feel pretty good about that. Move on. So now revenue is just going to be the units times sales price. Keep formatting. And then our COGS. Now, there's a sales price per unit here, a contribution margin. It'd be easier to just have direct costs per unit. And that's just going to be your sales price times 1 minus your contribution margin. So in other words, 75% of your sale price is direct costs and 25% is contribution margin. So your COGS are going to be minus your unit sales times that cost per unit. Let me just copy this number format down a little further so I don't have to keep doing it every time. And then I guess we can label each step, so we'll call that gross profit. Then we'll have our indirect costs. That'll get us to our EBITDA. Then we'll have our depreciation. That'll get us to our EBIT. And then we'll have our interest. I'll put in tax just for good order, but there isn't any tax, and that'll get us to our net income. So gross profit is just some of those two. Indirect cost. So again, we're going to XLOOKUP on the year in this indirect cost table, returning from here, and this time it's spread equally over the year, so just divide by 12 to get a monthly number. Oh, and put a minus sign in front of it. That's also important. Copy that across, and then get that. Then our depreciation, we just had a fixed number. Yes, $10,000 a month, and no capex expected. So then our EBIT, and just keep knocking everything off. And then interest, taxes, we need to work out the debt schedule for that. So I guess I could be a little more careful with my labeling. So let's say income statement. So then I'll just put the debt schedule right here below it. So you have opening, repayment, there's no drawdowns, closing, and interest. So the closing balance on the 30th of September is this. And I'm always a stickler for coloring in the different formula. Just because I use this kind of copy across thing a lot, like Control Shift right arrow and then Control R to copy across, which you should not do if your first column formula is different from the rest. Now the repayments, there is a schedule right here. And one quick thing, you can kind of eyeball them or you can do it with a formula, but just you can see that all of these happen at the end of a month. One way to check that is just month of that equal to month of that plus one. So that plus one is the next day. And if the month is not equal, they're all false. That means it all happens on the last day of a month, which means that our interest is always just going to be off the opening balance, not the average balance. So here you can either do a lookup with an error catch or you can do a sum ifs, either's fine. Here I'm going to say sum of the dollars, where the date is this month end date, which is H8. And sorry, I need a minus sign in front of that. And so let's check. After the 3-year period, we've paid off $1 million, which is what we're due to have paid off, so that's good. And then the interest is the opening balance times the interest rate, which is 7%. Simple interest per annum, interest paid at the end of the month. So just that divided by 12, copy across. Then we can come back up here and finish off our income statement. And I guess let's put in 0 and some of those, and there's our net income. So we've got our debt schedule. Now let's look at cash flow. Or actually, no. You know what? Let's do working capital. So we'll do our accounts payable, accounts receivable, and then the cash flow will be pretty easy. So let's start with receipts on sales, which is our receivables. So first we'll do the opening AR. I'm just going to do that in one line, balance, which again, we'll start off with whatever the number is, accounts receivable here, 600,000, and then it'll just be this minus so this and lock. So here this one is not locked, so I'm saying just the previous period. This one is locked, so I'm saying the opening balance times. You could either just do kind of one formula that you put in the first 3 columns here, and then just leave it blank or put 0 for the rest, or if you want to be a little more systematic and allow flexibility, if you want to add more dates later or whatever, you can do a sum ifs similar to before. So we'll say sum of these, where these dates, and they're formatted to not show the day here, so we'll just have to check that those are month-end dates, but I guess we'll figure it out pretty quickly if they're not, where that is, again, $8 is the month-end date. And sure enough, that is paid off within 3 months, so that obviously were month-end dates. So then, I'll just call it new AR, and that is opening, sales, receipts. So in other words, whatever your opening accounts receivable are, you make sales, you add, you make receipts, you subtract, and then you get your closing balance. So this one, by assumption, starts off as 0, and then the opening will just be that, the closing will be this, and then sales we have up here, and then receipts. That's the fun part. So the easiest way to do the receipts is just to say, we've got this set up the right way around. So it's this one here. So you get 0% of this month, 60% of last month, 25%, and 15%. So because it's not that many months that it's looking back, the easiest thing is just to have this formula here refer to this and the 3 before it. So I'm just going to mark these as things that have something in them and shouldn't be shouldn't have anything else put in them, which I do by that crosshash. And then we can just say sum product. Sorry, we'll need to put a minus on it. Equals minus sum product of these four with these four. So as you would expect, nothing gets paid immediately, and then most of this, 360,000 over 600,000 is about your 60%. So that's good. It gets paid in the first month. And after that, you can't kind of see it quite as easily. But a good kind of sense check is to say, if at some point I stopped having sales, does my receivables balance go to zero pretty soon after? And the answer is it does. So that seems to be working as expected. So that's the receivables. Now let's do the same thing for the payables. So opening AP balance and new AP. So the opening balance for accounts payable is this 350. And we need to reference a different table for this. So payables, yes, here and here. And again, the quick, oh, whoops, sorry. So I said I was locking this, but really I should only have locked the column and not the row so that I could copy the formula down. I can't copy it now because I've already edited the other part of this. But let's just pull this, pull this down here. And then we copy across, and again, sure enough, it's paid off within a couple of months, so that seems to be working well. Now the closing here is again 0, just by assumption. And here we have expenses and payments. So expenses, when we incur an expense, that adds to our accounts payable. When we make a payment, that reduces it. So our expenses in this case are, and I'll put a minus sign because they're with a negative sign on the income statement, are our COGS and our indirect costs. So copy those across. And then here, again, we just need to change which assumption we're referring to. So it's not the one in row 52, it's the one in row 60. And again, one more time, if we just delete that, we can see, yes, our payables balance goes to 0 pretty soon after. And I guess the other thing just to check is if I just do one standalone, that looks about right. You got about 5% there, 10% there, 85% there. Cool. Okay. So that seems to be working. So now we can do our cash flow. And there are 1,000,001 different ways to do cash flow. I guess I've done a lot of different versions recently, so I'm gonna, just to mix it up a little, I'm gonna do a direct cash flow statement here. So cash revenues, cash revenue receipts, I don't know, receipts on sales, I'll call it. I'm sure there's a more correct term, but that's what I'm going to call it. And that is going to be this. Again, I need a minus sign just to switch around because it's reducing accounts receivable, but it's increasing money in the door. And then the reduction in this, which is this minus this. Then payments on expenses, COGS plus indirect expenses. And again, that's going to be this plus, just be careful with the sign, this minus this, because we want this to be negative. So that's 105,000 gets paid off there. Then the 475 plus the 250, yep. So that seems to be working. And again, if you're doing the direct cash flow this way, basically getting this information from your AP and AR schedules is the only thing you need for this bit, and then you can just sort of follow the structure of the income statement. So, we've done COGS, we've done indirect cost. The sort of equivalent of depreciation is CapEx, but we're told there's no CapEx, and then no tax. So the only other thing is interest, and obviously because we're looking at cash flow, we're also going to look at principal payment. So debt interest, debt principal. So the debt interest is going to be from the debt schedule, which is right up here. And the debt principal is going to be here, and again, that's already got a negative sign because it's cash going out, which is exactly what we want. So then, is there any other cash flow I'm not thinking of? No, I don't think there is. All right, so then our net cash flow is just the sum of those. And then we're going to have closing cash. You could do opening and closing, but I'm being lazy. So again, just format that differently, and then it's just this plus that. And we zip along, and you can see that they're getting into trouble for terribly long. I didn't remember them getting into quite that much trouble, so maybe I've done something wrong. But anyway, okay. Anything I'm missing? No. All right, so let's see if we can answer some questions, and that'll tell me if I've made a huge mistake. I forgot to mention my time target on this one. Estimated time is 40 minutes. Oh, okay. I thought this was 30 or 35, so feeling pretty good about where I am in this case. All right, so sales revenue in January 2014. And sorry, let me just add a tab for the Q&A. How many questions have we got? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. Ba-ba-bum. By the way, I will say if you want to skip me answering the questions, that's totally fine. There is the last question here does involve kind of modeling a new scenario. So I always put kind of chapter breaks for the kind of main events down at the bottom of the video. So you should be able to click along to that. So if you want to just skip to the scenario piece, you are very welcome to do that. Unless I find out that I'm doing everything wrong. So sales forecast revenue in January 2014 is just this month, and it's there. So 363 closest to 364, so that's A. Closest to forecast closing accounts payable in December 2015, and by December 2015, obviously we've cleared all the opening AP, so it's just this bit down here. December, a little further over. Here we are, 771, 674, so that's closest to 772, which is C. Which of the following is closest to total indirect costs expected for the 3-year forecast? So for that one, you could actually just, sorry, I was going to say you could just come here, but you can't, of course, because the 3-year forecast is part of this year and part of this year. But anyway, sorry, I'll put a minus so that it's positive, and then I'll come up here, indirect costs. Is that 3.858, so closest to 3.9, which is A. Did notice this in the first couple of years that they seem to really hate answer D. A lot of A's, B's, and C's. Anyway, total interest expense for calendar year 2014. Pardon me. Sum of interest. By the way, if I was being more kind of formal about this, like producing it for a client model, for example, I would obviously, do a sum ifs where I reference the date range and have, input assumptions for, start date and end date and do this kind of properly. But I'm trying to do this in the way that I would really do it, doing a ModelOff question. And so obviously the easiest way to get 2014 interest is just to reference that period. And actually, in the sort of competition, I wouldn't even kind of do it in a sum like this. I would just kind of come here, select the relevant cells, and look at the little kind of status bar at the bottom to see the total. But anyway, so that's close to 125,000, which is B. What month will they run out of cash? So again, this is one where I would just kind of scan along. So here it is. First month they ran out of cash is June 2014, but if you wanted to do it a formula way, you could XLOOKUP true in closing cash is less than 0 and return from the month. Yeah, and it'll do the rest by default. That is indeed June 2014, so that's B. Based on the forecast, in what quarter does the cash shortfall peak? So, in other words, where is the largest negative? And the minimum is -8. I don't know if you can see my status bar. It might be cut off here, but I can see down at the bottom from selecting these cells, the minimum is -809,960. And then I can kind of zip along here. See, it's still ahead of me. Oh, there it is, in fact. So let's see, before that, the minimum is 784. After that, the minimum is 752. So yes, that's the bottom, and that's December 2015. So, and again, to do it a formula way, you could say XLOOKUP, let's just say -10 to the 7. In other words, a very large negative number in here, and return from the month number, and then this time I need a match mode, exact match, or next larger. So in other words, you look for a very, 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 very large negative number, and you say exact match or next larger. It means it'll match on the smallest number that's in there. That'll give you a date, and then what we want is to convert that to a quarter and a year, I think. So let's say let D be that. Then I want Q and round up D over 3, sorry, month of D over 3 to 0 decimal places, and year of D. Again, you don't actually have to do a formula to return all that to get the answer, but I'm going to put a formula in there. So Q415, which is A. Question 7. What debtor balance should the team be aiming for on the 30th of June 2014 to reach a set KPI? I always have to stop and think about these. Okay, so let's set KPI of 43 debtor days for the 9-month period ending 30th of June 2014 based on the average of the period opening and closing debtor balance. Okay, so I'm going to lay this one out a little. So opening debtor balance, and again, the accountants would kind of scoff at me for being as simplistic as this, but I always have to kind of stop and think, okay, debtor balance. Debtor means people owe you money, means they bought your stuff but they haven't paid you yet. Okay, that's accounts receivables. So we're looking at the 9-month period ending 30th of June 2014, in other words, from the start of the forecast to June 2014. So the opening balance is just the opening balance, which is receivables is what I want, right? That's what I just said, yes. Then sales in period is going to be sum of first 9 months. Days in period is going to be, let's say, 30th of June minus the 30th of September, which is the day before the first day in the period. That's 273. So I guess target average balance. Well, I guess let's just say target days is 43. So the target average balance is this divided by that is your sales per day times 43 is 590. And so if you want the average of this and something else to be equal to that, then target closing balance, it's going to be 2 times that minus that. Just going straight to the maths. If that doesn't feel intuitive to you, feel free to write it out. But the good way to check is the average of this and this matches that. So that's good. I guess to make it a check, I would do this and then expect it to be 0. So that was a very waffly way of saying my target closing balance is 580,453. Sorry, move this a little further over here. All right, so 580, okay, it's about 580, which is C. Question 8, calculate EBIT and provide backward-looking interest coverage ratio for the year ended 31st December 2015. So that's just going to be my EBIT for 2015 divided by my interest for 2015 is my EBIT coverage. Again, it's the kind of thing, the kind of thing that was spelled out a lot more clearly in questions in later years, which I quite liked because I didn't know a lot of this stuff back then. I sort of kind of know it now. But All right, so that over that is 1.23, which is about 1.2, which is closer to A. And finally, the scenario question. Recognizing the upcoming cash shortfall, the board orders a review of your sales terms based on analysis. If the following strategy were adopted from the 1st of January onward, what would the cash balance be closest to at the end of 2015? So we increase our sales price by 12%. Forecast sales volume is lower going forward by 5%, and direct cost per unit is maintained. Now, let's talk about this. You should make a copy of the sheet your model appears on and name the new sheet Sense for sensitivity. Use this sheet to do your sensitivity analysis. Shade any cells you directly change in bright yellow. Let me tell you, I understand why they did this, because they wanted to be able to review the models, and having the two side by side with big yellow things for the changes makes it easy to do that. But please never build your model like this in the real world, because if you do it like this, where it's the last question, it's the last time you ever touch the model, it's like, fine, what's the worst that could happen? But if you do this in the real world, you're just begging for version control issues between your models. So please don't ever do that. Instead, have some scenarios. And how are we going to do that? Let's have a new assumption here, which is board scenario. And we'll have an effective date, which is when it kicks in. Let's grab a date format from somewhere. Sorry, I really wanted this format. Boom, and then 2015 1/1, and format that then as a date. Then what else? Sales price increase. That is 12%. 12, not 15. Volume decrease. That's minus 5%. And active. True. We can just make this true or false. Obviously, you don't have to do all the formatting of the drop down and that kind of thing in the competition. Okay. So then, unit sales. So here we're going to do base, sensitivity, and then unit sales actual. And then here we'll just have if the date is greater than or equal to this, then this, otherwise 0. Copy across. And then we'll just have this times 1 plus that. And then just everything that points to this, we want to have a point to that instead. And so if I come here and I have false, it shouldn't change anything in my model. If I make it true, then it should. Here. Oh. Oh, sorry. Yeah, don't have it kicking in soon enough. It's supposed to be 1 Jan 2014. Then it kicks in. And sorry, that wasn't actually because I did true or false, because so we're going to say and scenario is active, and that is true. So if the scenario is active and we're in the date range, then do it. Otherwise, don't do it. Fine. Now it's working the way I want to do. So then, everywhere that points to the first one, I'm just going to change it to point to the second one, copy all across, and gross profit, again, copy all across. And then I guess I should call this volume sensitivity. And then I will call this price, line break price sensitivity. The formula should be almost exactly the same, so I'll copy it first for formatting and then take this. But now I need to point to a different cell, which is this. So now, instead of just multiplying by the price, I want to multiply by price times 1 plus sensitivity, which again, if I set this to false, means nothing changes. And you can see as I copy it across, none of these values changed. That's good. But then I set it to true. And what I should see is this is now, yes, kicking in. So let me just copy, value, paste a few of these for a minute. Sorry, Alt-S-U so I can see. And then if I turn it off, so your 363 has become 387. So in other words, it's going down by 5%, up by 12%, ends up about 7. That seems a little. Yeah, it's up by 6.4%. Okay, so yes, that seems to be working about as it should. So then the question I need to answer is, what happens to closing cash on the 15th of December? Minus 800,000. That seems bad. Oh, sorry. That's because the scenario is not active. Okay. Yes, our turnaround plan is successful. We're positive 261,687. Now, let me just, in order to actually have my answers stay the way I want them to on here, I'm going to put my switch on here, and I'll just do a data table for this one. And sorry, put it here, and we'll say false, true. You have to, for whatever reason, you have to have the assumption cell that's driving the data table on the same tab. So now I can point that to there, which is closest to B, 260. And then if I put that to false, all the rest of my answers should behave the way they're supposed to. So link, and then I'll just hard code here. And let's quickly check we got them right. So 363, 879, yes. 771, 674, yes. 298, yes. 358, yes. 30th of June, yes. Q4, yes. 580. Hooray! Okay, that worked. All right, so that's all I've got for today. Next video, last question from this round is on LBO modeling, and I will be hopefully back with that on Friday morning, 9 a.m. Eastern Time. Thanks for watching. See you next time.